Welcome everyone. In today's video I wanted to do a guide on how to use leverage yield farming platforms such as Francium in order to create pseudo delta neutral yield farming positions. And so just to get a couple of things out of the way first, like I have created tutorials on my channel before just discussing this, but I wanted to create sort of a united video just discussing all of it in one video, and like the sound quality for this is a lot better than the other ones as well. So if anyone asks how to do this, then you can go ahead and send them this video as a reference. Additionally, none of this is financial advice. And lastly, this video is purely just a proof of concept, meaning that you can go ahead and do this on any leverage yield farming platform that you want to. So whilst I'm using Francium on Solana, you can go ahead and use Tulip, you can use Alpha Homora, you can use Alpaca Finance on BSC. You can use any leverage yield farming platform you want in order to execute these strategies. So now that the intro is out of the way, let me just explain a couple of things. And the first thing I think I really need to sort of clear up is what delta neutral is, or what it means to be delta neutral. So I have this definition here that comes from Investopedia, so I'm just going to read it out. So delta neutral is a portfolio strategy that utilizes multiple positions with balancing positive and negative deltas, so the overall delta of the assets total zero. So a delta neutral portfolio evens out the response to market movements for a certain range to bring the net change of the position to zero. So that was a bit conceptual. I will give you an example of what might happen. So in this example, let's just say we're long 1 ETH on Mango Markets, and that gives us a delta of 1. And then we're short 1 ETH on Drift, which gives us a delta of -1. And so when you add those deltas together, we just do a quick 1 minus 1 equation. It gives you a delta of 0, meaning that you are now delta neutral. So if the price of ETH went up 20%, the value of your portfolio would stay flat. Now that's because although you're long, the value of your long position is going up 20%, the value of your short position is going down 20%. Therefore, if you net that out, your portfolio is actually not gaining or losing any value. So it's gaining on the long, but it's losing value on the short. Now, if you flip that and said the price of ETH went down 20%, then your long position would go down by 20% and your short position would go up by 20%. But effectively, the value of your portfolio would stay the same. So why would you want to do this? Particularly with leveraged yield farming? Well, you can utilize leveraged yield farming to create long and short positions on yield farms to create a pseudo delta neutral position that can harvest crazy yields. So there's two ways of doing this. So we have pseudo delta neutral hedging, and the second method is called borrow farming. So there are probably lots of different names for these particular strategies, but I'm just taking what Francium is calling them, and I think it's just easier because I'm using that platform for today. So if I call it the same thing, it'll be easier for you to understand what's going on. But like Alpaca Finance might call it something different, Alpha Homora might call it something different, so just keep that in mind. So let's just take a look into the pseudo delta neutral hedging strategy first, and I'll explain exactly what happens. So essentially what you're doing, you're creating a long farming position and then a short farming position, and hopefully the size of both of those positions should cancel each other out. And just one thing to note, that it's not perfectly delta neutral, so you're getting about as close as you can whilst using leveraged yield farming to delta neutral, but it's not perfect, right? So Francium have a really good strategy talking about the delta neutral hedge strategy. So I'm just going to read this out to you, and then I might explain some finer points to it. So in their example, they have $400 in USDC in order to create this position. So you start with $100 and you use that to leverage yield farm with 3x leverage the ETH USDC pair, and then you would use USDC as your asset to borrow. So effectively what you've done there, you've deposited $100 and then you've borrowed $200 worth of USDC, and then the total position is then worth $300. So since you're leveraged yield farming, your position needs to be 50-50. So it needs to be 50% worth USDC and 50% ETH. So what happens is that $150 of this borrowed USDC is then converted into ETH, and effectively that gives you $150 worth of ETH long exposure. And then with your remaining $300 from your initial $400 investment here, what you do, you'd 3x leverage yield farm the ETH USDC pair, but instead of borrowing USDC, you are now borrowing ETH. So you deposited $300, and now you borrow $600 worth of ETH. So the total position value there is $900. So again, because it's a 50-50 position when you're yield farming, basically $150 worth of that ETH is then sold into USDC in order to create a $450 USDC position and a $450 ETH position, which is like, so that's 50-50 of $900. So that effectively creates a $150 ETH short exposure on this $300 that you deposited. So if I just go back to my slides here, hopefully I can break this down a little bit so you can understand it easier. So you start off with the initial $400, right? And then $100 is then used to 3x leverage yield farm the ETH USDC pair, but you're now borrowing USDC for this. And that creates a $150 ETH long. And then with your remaining 300 USDC, you 3x leverage yield farm the ETH USDC pair, but now you're borrowing ETH, and that creates a $150 ETH short position. So $150 long minus $150 short gives you effectively like zero exposure to the price of ETH. Now remember, this is pseudo delta neutral, so whilst on paper it looks like you have zero price exposure, you don't quite have zero price exposure. But let's just say you have zero, but you're also claiming yield as well from the yield farm. So I'll show you what this looks like on the Francium calculator. So if I go into Francium and I go into the calculator, I can show you what this looks like. So if I go to Wormhole ETH USDC, I go to advanced mode, and then 25% on the USDC, and then 75% on the ETH. Let's crank this leverage up all the way up to 3x leverage. So this is what your equity curve is going to look like. So just remember that you start off with 100%. At the end of 15 days, assuming the price of ETH hasn't moved, you've made a 6.15% gain. And then you'd actually need ETH to go down 33% for you to start losing money. And then you'd also need it to go up about 45% for you in order to start losing money. So if I crank this up to 30 days, and then you get even sort of a better buffer for actually making or losing money. So at the end of the 30 days, you've made 12.48%, and that's assuming the price of ETH hasn't moved. And then you start losing money if the price of ETH goes down about 46%, and then if the price of ETH goes about above 70%, and then you start losing money. You can actually still get liquidated on this because you are using leverage. However, you can just use a stop loss, so that means that you could potentially only lose like 10% of your equity, but ETH isn't an asset that moves a lot, so you can sort of be safe in the fact that you won't get liquidated, because it's unlikely the price of ETH is going to go down 96% in 30 days. Like, that's just not going to happen. So if we just take a look at this from a year's time frame, let's just say the price of ETH doesn't move, well then you've made 213%. And now if the price of ETH doubles, you've still made, like 225%. And the only scenario in which you're doing this and you lose money is if the price of ETH goes down 99% by the end of a year. So in all the other scenarios here where the price of ETH could go down like 70%, you've still made over 100% gains. And so if you just mess around with this calculator, you can see exactly how much money you could make or lose. But just remember, this isn't perfect because the borrowing rates for both ETH and USDC are going to fluctuate over time, as well as the yield that you're actually receiving. So whilst it is nice to see, like how much money you might make on like a yearly time frame, it's unlikely you'll ever make this, right? So, I think it might make more sense to sort of base your delta neutral yield farming strategies off like a 30 to 45 day time period, because it makes more sense that you would do that, especially since crypto is so volatile. prices could fluctuate massively in that time. And I'll talk more about some tips and some advice if you're actually going to go ahead and do this, because you're not going to want to use any meme coins or any like dog related coins, because they're going to be far too volatile for you to actually go ahead and execute this strategy. So if you wanted to go ahead and, you know, like actually do this, do the pseudo delta neutral hedging strategy, I'll show you how to do it. So you can go to farms, and then I just want to do it on wormhole ETH pair, right? So let's just go into this one. So this is the wormhole ETH USDC pair on top of Orca. So if I click on farm, what's nice about Francium is that they have the pseudo delta neutral hedging strategy already set up as a template. So if you click on this, it will set it up automatically for you. However, let's just say you're on a platform that doesn't do that. So I'll show you how to do it. And let's just say you have $400 to do said strategy. So if your leverage yield farming platform has borrow to assets, then turn that on. It makes this a lot easier. And so you want to shift this to get the right ratio. So if you're doing the pseudo delta neutral hedging strategy and you're only supplying USDC and you're only supplying stablecoins, you want the assets to borrow being 25% stablecoins and then 75% whatever asset you're yield farming. So in this case, I've got 25% of the USDC that as the assets that I want to borrow, and 75% of wormhole ETH as the assets that I want to borrow. So that's how you'd set it up, and then you can go ahead and press farm. What's nice about Francium as well is that they allow you to set up a stop loss. So remember that you can basically just do this on any asset that you can actually go ahead and borrow on your leverage yield farming platform. And on Francium, you can find out what assets you can borrow by going to the Lend tab, and then basically MSOL, StakeSol, Bitcoin, ETH, Ray, BNB, Uni, Sushi, Serum, Atlas, Polis, Orca, Samo, Gene, DeFi Land, Shadow, and basis markets. Those are all the coins that I can do this on Francium. And of course, whatever leverage yield farming platform you're on, you can just go ahead and check which ones you can actually do it on. Now let's go ahead and take a look at the second strategy, and the second strategy is borrow farming. So I'll just give you a little breakdown on what's happening here. So let's just say you have 400 USDC again, and with that 400 USDC, you would 2x leverage yield farm the ETH USDC pair, and in this scenario you would be borrowing ETH. So effectively what you've done there, you've deposited 400 USDC and then you've borrowed $400 worth of ETH. So your farming position is going to look like this: 400 USDC and $400 worth of ETH. So like this, because it's like a 50-50 farming position, remember. If you actually use any more leverage than say 2x leverage, then what you actually do is you incur a short position. But here, because we're using 2x leverage, you're not entering a long or a short position because you didn't convert any ETH into USDC. And when you do that, effectively what you're doing there is creating a short position, and you didn't convert any USDC into ETH, which creates a long position. If you want a little bit more color on how this works and a little bit more explanation on this, how to leverage long or short sell using leverage yield farming, then I have a tutorial on my channel. I'll link it in the description down below. One on short selling and one on going long particular coins using leverage yield farming, because if you don't fully understand what's going on here, I think that it probably makes sense to go ahead and watch those videos as well. So let me go ahead and show you how it would look like on the yield farming calculator with this borrow farming strategy. So let's choose a wormhole ETH USDC on Orca. Asset to borrow will be wormhole ETH, and we'll have it at 2x leverage. And you can see here that the equity curve is flat. So if I change this to USDC, effectively what you're doing here is you're leverage longing. If I change it to wormhole ETH, you're effectively going delta neutral. Well, you're going pseudo delta neutral. It's not perfect. So if we go to a 30-day time frame, right, so assuming the price of ETH doesn't move, you've then made 8% on your position, and then you only start losing money if the price of ETH goes down about 47%, or if it goes up more than, say, about 70%, right? So it's very similar to how we had the pseudo delta neutral hedging strategy set up before. So if I just compare this for you, let's do this again. And just take a look there. So the pseudo delta neutral hedging strategy equity curve is very similar to the borrow farming curve. So if I just do that, and there we go, we can see that it has a similar sort of equity curve. So if you're going to go ahead and do this strategy, I'll just show you how to do it again. So we go to wormhole ETH and we can choose this farm here. Let's just say you have $400 and we want to do this. So of course you can just go on the borrow farming template that they have here on Francium, but let's just do this manually. So we set the leverage to 2x and then the asset to borrow to wormhole ETH, and then there you go, you've got it set up. So if you click on the simulator, you want to make sure that you've got it up correctly, and this is what it's going to look like. And if you add stop losses to it, this is where your stop loss is going to be. So you go ahead and press farm, and you can go ahead and actually open that position. So remember, basically, similar to the pseudo delta neutral hedging strategy, you can do this on any asset that you can actually borrow. So if you wanted to go ahead and do some pseudo delta neutral yield farming, which strategy would you prefer to use? So we have the pseudo delta neutral hedging strategy here, and the equity curve, and we have the borrow farming equity curve here. So at the end of 30 days, assuming that the price of ETH doesn't change, you've made 12% on the pseudo delta neutral hedging strategy, but on the borrow farming strategy, given the same parameters, you've only made an 8% return. So that's just one thing to note, that you are going to make higher returns using the pseudo delta neutral hedging strategy versus the borrow farming strategy. However, you are going to take on more risk because, as you can see here, there is a liquidation price. I mean, it's at like minus 96%, so it's unlikely for you to, have that hit, especially when you're trading something like ETH. Especially when you're farming something like ETH. But that is something that you are going to have to be aware of, is that there is still liquidation risk on both of these, but you are more likely to get liquidated on the pseudo delta neutral hedging strategy. And if we just take a look at it on like a yearly basis, for the pseudo delta neutral hedging strategy, you've made 212% gain, assuming the price of ETH doesn't change. Whereas on the borrow farming strategy, you've actually made a lot less. You've only made 146% gain. There is more risk but more reward with the pseudo delta neutral hedging strategy. So there is definitely more risk, but there's also more reward with the pseudo delta neutral hedging strategy. And now to just end off the vid, I just want to give you a few tips. So first of all, if you want to do this strategy, think about it on a 30 to 45 day time period, because crypto is just so crazy. You don't really know what's going to happen over the longer stretches of time. Like, things can easily draw down like 70% within a very short amount of time. I mean, like, this is crypto, like anything can happen. Another thing that you might want to do is actually use a stop loss, because, like, say on Francium, for example, this is on Solana, and there have been many problems where the network has gone down, and that's a big issue, because a lot of people actually got liquidated because they weren't able to close positions or they weren't able to repay debts. So if you have just an automatic stop loss set up, you actually be fine in periods of like market volatility, and if the network is like spammed with transactions, your automatic stop loss will kick in and you won't have to like get liquidated. Another thing that you'll want to sort of be conscious of is the fact that you don't want to execute these strategies on like meme coins or like ultra low cap, low liquidity coins, right? So something like Samo, for example, it's a dog coin. It's like Solana's premier dog coin. I wouldn't ever recommend doing delta neutral yield farming on that, because the price of Samo could go up 50% within the space of like, the price of Samo could go up or down 50% in the space of like a week. And in those times, like, it's very likely that you could get liquidated. Or if you're like going to be farming some random low cap coin, someone could easily manipulate the price of that and liquidate you. So just keep that in mind as well. And this strategy isn't something that you can just set up and walk away from. You're going to have to actively monitor it and rebalance as the price of whatever asset that you're farming, moves in and out of certain ranges. So just keep that in mind. So this video wasn't like a fully in-depth, comprehensive sort of tutorial on pseudo delta neutral yield farming. It was more of like an introduction, and there are definitely lots of places where you can go ahead and become more familiar with it. The Tulip Discord, for example, is great for that. The guys over there are great. They'll answer a lot of questions that you have. The Francium Discord, if you go to any of these leverage yield farming platform discords, then I'm sure people will be there and open to helping you. So thank you for watching. I hope you enjoyed this video, and make sure to subscribe for more videos like this one.